You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
All right, everyone. Happy Friday. We are 2 weeks and 4 days away from one of the craziest presidential elections in history. And today and every Friday leading up to Election Day, we are going to focus on the stock market and the election. But first, as always, a few housekeeping items. If this is your first time watching or listening, then thank you so much for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, happier, wealthier, and educated than you were before you started listening today. So come back often. Please feel free to subscribe. We're on iTunes and YouTube. In addition, you can also follow me on Twitter at Adam Koós and on Instagram at Financial Surgeon. Last but not least, all links, visuals, and charts and other educational resources are on our website at libertaswealth.com. There's a drop down. You'll head down to podcasts, and you're going to see all the charts that I'm going to show you, all the images, tables, and it looks like we're going to have about 7 of them today. So let's go ahead and get started. So you're kind of in a treat today. So today at my office, aside from the fact that I've got a cold and I'm struggling to keep my voice straight, and I'll probably sniffle and cough at you throughout this podcast, and I apologize in advance for that. I was trying to get the podcast started at the office, and I couldn't get my microphone to work. It wasn't working for me. So I figured out how to get it working, changed a couple USB inputs, then I lost my webcam. And then when I tried to get the webcam working, then I lost 2 of my screens, and I have 4 at the office. I have 3 here, so I lost 2 of my 4 screens. So then I thought, you know what, I can't get the 2 screens working. I think I'll try to restart the computer. So I restarted the computer, and then I lost all 4 of my screens. It became completely inoperable. So the problem I have here at home is we have not taken the time yet to put the acoustics up in my home office. Since we moved to our house, which was a long time ago at this point, I have a music studio in the basement, and we haven't even used the music studio because I've been too busy with work. So as you can see, you've got a keyboard over here. You can't see the setup in front of me here, but I do have a music studio that sounds absolutely horrible, as you can hear, so I apologize for the lack of sound quality and all the echoing, because like I said, I haven't treated this room acoustically yet. But let's go ahead and jump into this. We're going to talk a lot about the election, the stock market, and what we have looking ahead here. Like I said, 2 weeks and 4 days from now, when the election hits. So I always like to start with a quote. So quote of the day today comes from M. Scott Peck, and he says, "Human beings are poor examiners, subject to superstition, bias, prejudice, and a profound tendency to see what they want to see rather than what's really there." And I think that couldn't be any more true today as we're leading up to the election. You've got, I don't pay much attention to Facebook, to be honest, but you've got Facebook, you've got Twitter, you've got other social media venues that you could probably watch that are getting you all fired up about the election. You've got the news, you've got commercials. Of course, you've got your average everyday conversation with friends or neighbors that you might probably shouldn't be having if you're talking about politics. So the good news is hopefully it's going to be over in 2 weeks and 4 days, although we might not know who our president is for a while, depending on how crazy things get with voting and counting votes. And this is the cover of Time magazine. For those of you listening on iTunes that can't see my screen, this is chart number 1, we'll call it, even though it's not a chart. It's just the cover of Time magazine with the White House at the very bottom, very small, with what looks like 4 smokestacks or chimneys, with the coronavirus cells pluming out of it to the point where it's covered in almost the entire cover of the magazine, and you can barely read the word Time. And this is just an example of one of those things that when it comes to emotions and biases and the things that kind of freak us out in life and with our money, that we just need to kind of avoid paying attention to things like this, because all it's going to do is distract you from the realities. And that's what I want to do. I want to talk about some of the realities today. So before I move on to some information about performance, stock market performance in election years and post-election years, like the one we're about to walk into in a couple months here, I started this election tracker. And what you're seeing on your screen here, again, for those on iTunes, I'm looking at chart number 2. It's a chart of the S&P 500. And what we're looking at is the 3 months before Election Day. And there's a statistic out there. Ryan Dietrich came up with this statistic, posted a couple tables. It's been in our market commentary. If you want to look back at Coach's Corner articles or educational articles on our website, you'll see the table that I'm referring to. If you look back at some of our old commentary on our website, feel free to refer to that. But what the statistic is that the S&P 500 has a tendency to predict or accurately predict the winner of the presidential election 87% of the time. So what I mean by that is if you look back at the 3 months prior to the election, if the stock market is up, then whoever the incumbent candidate is, whether that's the Democrat or Republican, doesn't make a difference, whoever the incumbent is, if the stock market ends positively on election day, looking back 3 months, then 87% of the time the incumbent wins. Conversely, if the stock market is down in the 3 months trailing the election day, so if on election day, looking back 3 months, the stock market is down, then the challenger tends to win. So what we're looking at here is a chart that I've been tracking now for a couple weeks. I'm posting it at least once a week on Twitter. I'll do it in these podcasts as well, and probably our market commentary, our written market commentary, and the articles that I write. But what we're seeing is basically what the stock market's done since that trailing 3 month time frame, which would be August, and then where it's at today, and a horizontal line here in the middle of the screen that basically says if we're above this line on election day, there is a higher probability using historical statistics that the incumbent president would win, and if we close below this red line, there is a higher probability that the challenger would win. Now you can say whatever you want in terms of, well, we're living in a crazy year. We're living in a year of the pandemic, COVID-19, and then you'd be right. And these are all statistics. These are just historical statistics. It's no promise that this is going to be right again. In fact, it's entirely possible. This could be one of the 13% of times it doesn't work, right? So we'll just have to see, but it's still a fun statistic to keep track of, and it's going to be interesting to see how it pans out. So like I said, I'm going to keep tracking this each and every week, at least once a week, that is. The next thing I want to show you is a couple tables. They're very, very similar, but just different time frames. So for those of you listening on iTunes, what we're looking at here is the average performance of the S&P 500, so the stock market, based on what year of the election cycle we're in. So whether it's a post-election year, a midterm year, a pre-election year, or an election year like the one we're living in right now. Historically speaking, if we go from 1926 to present, the best performing year for the S&P 500 is the pre-election year, which would have been last year. In this case, it would have been 2019, with an average rate of return of 18.5% per year in the third year or pre-election year of the election cycle. And also it has a 92% positivity rate, meaning that 92% of the time a pre-election year is a positive year, which is a really, really obviously very strong number. Election years are number 2. So the second best performing year of the 4-year election cycle is the election year, which is the one we're living in. Average rate of return is 11.3%. Obviously, we're nowhere close to that this year, obviously. But that being said, 83% of election years are positive. Now, the third best performing year is the post-election year, which would be next year, with an average rate of return of 9.9% and a 57% chance of being positive. And then the midterm year, or the off-cycle year, is the worst performer if you go 1926 to 2019. So you might think to yourself, okay, so last year would have been the best year historically speaking. This year, second best, and then next year we don't have a whole lot to look forward to, but give it a coin toss as to whether or not it's going to be positive, just looking at history alone. But if we move forward and we look at some more recent statistics, so this next table that I'm showing you, which would be, let's see, I guess technically this would be chart number 4. If you refer to our website online later, if you're listening to this in the car or on your headphones, chart number 4, what we're doing here is we're looking at the same exact table, the 4-year election cycle, but we're looking at the statistics more recently from 2005 until 2019. Now, obviously, this is a much, much smaller sample size, but we still find it interesting with some good news in that while this year, an election year, would average a negative return of negative 3% per year, and while the midterm and pre-election years, or last year in other words, average about 10% per year, the post-election year has been very, very positive the last couple decades, or call it 15 years, at 21.4%. Now, again, I can't reiterate more. This is an extremely small sample size, so I don't think it carries a whole lot of weight, but I do think that it's interesting to look at and at least lends potentially some positive evidence and some positive emotions that I think we all need right now. So that's all about the election today. I want to move on to some charts and show you what I'm thinking is going on in the stock market today. First and foremost, we've got two lines here. So in the black, the candlesticks here, I know that they get messy. Some people don't like candlesticks. I love them. Candlesticks give you so much information on one little candlestick, but I'm gonna skip the education on how they work today because I don't want to make this too long. And I'm not feeling well, and that means I'm talking slow, which means this might last even longer than it normally does. So let's just move on here. So the red line, the red dashed line, horizontal line, is the January 1st price. So in other words, it's where the market was, the stock market was on January 1st. And the reason why I think this has significance is because it tried to get below this level back in February, and then it failed and it had higher, which is good, right? Then the market peaked and it broke down, and we had the waterfall decline, obviously the fastest stock market crash in U.S. history in only 22 days. And then it peaked in June just below that year-to-date level and then pulled back. Then it broke above it and tried to get back below it here in July. For those of you on iTunes listening, it's basically what I'm saying is that price tried to get above this January 1st year-to-date line. Then it pulled back, and then it held that line and then broke out. And then most recently in September, we had obviously a correction in September. The market was able to hold that January 1st year-to-date line almost exactly, which is really, really interesting. And so there's a lot of potential support there, I think, as what I'll call maybe a worst-case scenario, or I shouldn't say worst-case scenario, but I think this red line is the lowest that I would want to see this market go before I think that there'd be some serious trouble on the horizon. So that's the first line, or worst line, we'll call it. The next line up here, the horizontal line on top, this is this marks the February highs. So the previous all-time highs in the stock market back in February before the coronavirus crash. You can see we broke above that here in August, pulled back again to that year-to-date line, broke back out again, and now here we are in October, mid-October, about, like I said, almost 3 weeks away from the election. And if we were to, I think that this blue line, the February highs, could also be a level of potential support where the market could hold above that level. And if it doesn't, the other thing we have here is this nice smooth blue line. This is the 50-day moving average, or in other words, the average movement of the stock market over the last 50 days, which is a great level of institutional support. It also is the same, or similar, I shouldn't say the same, but very similar to the 10-week moving average. And the 10-week moving average, which you don't see on this chart because this is a daily chart, not a weekly chart. You wouldn't see a weekly moving average on a daily chart. But the 50-day moving average is very similar to the 10-week, and the 10-week is a moving average that a lot of institutions, institutional money managers pay attention to. So I think that we have some potential support here pretty solidly above this 50-day moving average, which is converging with the February highs. So these are kind of the levels I'm watching as potential floors of support below our feet, some good risk levels. So if we were to break below this blue line here in the 50-day moving average, that would be concerning. I'm assuming that that would be concerning, and it would be a reason to throw up a yellow light at minimum. A level, kind of err on the level of caution, on the side of caution. So I would still be optimistic, even if we broke below this red line. If we were to reclaim this red line within the first, call it, few trading days, that would be what we call a shakeout. In other words, if the market closed below this level, it might shake out some weak hands, some nervous investors that might sell, and then if the bulls jumped back in and buyers stepped in and started pushing prices back northward again, then that would be it would basically confirm that shakeout, and we'd be in a good shape to head higher here. But anyway, so that's kind of what I'm seeing here on this chart. If I move forward to something a little bit simpler, I don't talk about cup and handle formations a whole lot. Obviously, as a technician, I love bases and patterns, and there's all kinds of patterns. Probably one of the most common is head and shoulders. People like to put head and shoulders lines on everything, obviously, and half the time they're not accurate patterns. But triangles, rectangles, big bases, there's all kinds of patterns, and there's reasons why they work in terms of technical analysis and confirmation of these patterns when they play out. But in this case, what I think is happening here is we're seeing a cup form, which is a pretty high probability pattern, and then we're seeing the right side of a handle. When you have a cup form without a handle, it's usually called a saucer, especially if it's got more of a wider base, kind of a drawn out base, more like a bowl than a cup. But you have this cup forming, kind of a not quite symmetrical, but pretty symmetrical cup with a pullback recently. So we might be seeing a handle forming here. And if that's the case, then I would expect the market to head higher from here, not lower. Obviously, if it were to continue breaking down, especially below this level, which again corresponds with the June highs and the year-to-date number, January 1st price, then that would be a problem. So that's what I'm seeing here. And then last but not least, last chart I want to share today is super, super, super long term. This is something that I watch every single month, and it's not even valid right now because it's the middle of the month. But I find it interesting that intra-month, we're starting to see momentum curl up here in the bottom pane. This is relative strength index, which is a momentum indicator. It looks back 14 months, and what we're seeing is lower highs in momentum with higher highs in price. And if I say that backwards, which is how I should say it, we're seeing higher highs in price, but we're seeing lower highs in momentum, which is not good. That's kind of a bearish or a negative clue or a negative piece of evidence. Now, we won't know until the end of the month whether or not this is valid or not, but right now it's kind of make or break time for the S&P 500. Either A, this thing's going to continue its lower highs, and we'll have to see what happens with the market here with the election coming up. But obviously, if price has a tendency to follow momentum, and if this continues down with lower highs, then we could see in the months ahead into next year, we could see some negative price movement. But for now, this is one of the only very few pieces of negative evidence that I see, honestly. I think the market still looks very good, and if for those of you out there that are looking for a why, looking for reasons why it looks good, I think the primary reasons is we have an election coming up. I think we have the Federal Reserve is providing a lot of liquidity that makes its way into the market, and that props the market up. I think we have a zero interest rate environment where people who would otherwise be more conservative with their money are looking for yield because they can't get it in their savings accounts, they can't get it in CDs, so they can't get it at the bank, so they're going for stocks with dividends, or maybe they're taking more risk than they otherwise would because they're searching or they're reaching for yield elsewhere. And then I think we have the potential for, a very high potential, for more stimulus ahead. Now, we can argue all day long about whether or not stimulus is good for the economy long term, and I'm not going to argue about it. So, but I think that stimulus would be good for the stock market in the short term. So that's what I'm seeing today. If you have any questions at all, you go to the contact page here. Please feel free to reach out. But that's all for today's show. Feel free to share this episode with your friends and family if you'd like to discuss your personal situation further. Please remember that you never have to be a client to ask a question. We have a second opinion process that we take our prospective clients through, so new clients, that includes 3 appointments, 1 2-hour discovery meeting, 1 education meeting, and a 90-minute financial planning meeting. And if you'd like to go through that process, we would recommend that you first schedule an introduction call just to chat, get to know each other, and see if we'd even be a good fit to go through that process. But if you'd like to set up that introduction call or a Zoom meeting, head over to our website to schedule something on our calendar. You can get access to our calendar there. As I always say, though, there are thousands and thousands of podcasts out there, and you chose to give ours a listen today, so thank you so much for tuning in. Please be sure to subscribe on iTunes and YouTube, and remember, you can sign up at libertaswealth.com, I believe on our contact page, as well as many other pages, to receive updates for these podcasts, as well as other screencasts, videos, and articles that I write delivered directly to your email inbox. Feel free to follow us on Facebook at facebook.com/Libertas Wealth. Again, I'm also on Twitter at Adam Koos, as well as Instagram at Financial Surgeon. So thank you so much again for taking the time to tune in, for joining us today, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.